Kevin, thank you so much for joining us today. We presented with you a couple of years ago, and I was very impressed with your presentation. Uh, so much so that as soon as we started thinking about what we're doing now, you were one of the first people that popped into my brain and potential interviewee. And so I really appreciate you coming on the program, so to speak, and
Yeah. Yeah, no,
tell us a little bit about yourself and insurance, because that's what you do.
sh- sure, sure. So, my wife and I opened an insurance brokerage that differs from kind of a captive insurance agency where, as an independent broker, we have more than 80 carriers, which is quite a few, more than the average insurance agency. Um, Started out, we were in insurance. We were with State Farm previously, decided that we wanted to have our own brokerage to give broader options and more options for us. And that evolved to where we're now licensed in 7 states, got well over 80 carriers, and we've got offices in Las Vegas and in Reno. Reno's kind of where we are headquartered at the moment. And, we all things insurance except healthcare. So anything that somebody comes across and needs, we can handle. If somebody's got a weird collectible item, we've got several carriers. If they want properties, investment properties, anything that they have, we can pretty much help them.
Okay, so what's the difference between a regular carrier like State Farm or AAA and a broker like yourself?
Sure. So, easiest way to think about it, when I present on this, I usually have two pictures up on the screen. I've got a picture of the cereal aisle in the grocery store, and one picture is of Cheerios. You can get Honey Nut Cheerios, whole wheat Cheerios, frosted Cheerios, but you get Cheerios. That's a captive. That's a State Farm or a AAA. They're one company that's represented by their agency. So if you go see a State Farm office driving down the street, they work for State Farm. They have an agency, they're an agent, but they effectively represent one company.
Right.
As a broker, we don't work for any insurance company. We represent and are appointed with a variety. So if you decide you don't want Cheerios and you want Frosted Flakes or you want Captain Crunch, we can get that. The biggest difference is that when somebody comes to us, we're able to look at their circumstance and find a variety of solutions that fit what they need. When you go to a captive, they have one company. So they may adjust that product to fit your need instead of finding the need to fit what makes sense to you. So,
Right.
let's say you for instance, you've got your personal stuff, but you also may have investment properties. Well, it may make more sense to take some of those investment properties and put them with one type of company because it's a better coverage and fits your need better.
Hmm.
So that's the flexibility we have.
So what states are you in?
So we are in California, Nevada, Idaho, Arizona, New Mexico, Ohio, and Tennessee.
Okay, so why Ohio and Tennessee? Like the other ones are all West
Yeah.
Coasters.
Yeah,
So,
I used to live in Ohio and I used to live in Tennessee.
okay.
So we when we got into insurance, we were out there, and kind of got licensed out there,
Hmm.
and then over time moved, and then we just kept those licenses active. Um, and the brand we're with, Goosehead Insurance, they're a little bit about them. They're the largest personal lines brokerage in the country. And they don't really advertise. So most people don't know about them.
Hmm.
But that model allows us to open up our brokerage. My wife and I own this brokerage. And think of it as a franchise.
Okay.
And because of their model, they don't have territories. Whereas if you went to open a state farm office, they tell you you can operate in this zip code, and they kind of frown on you going and chasing business that's tripping over somebody else.
Sure.
Goosehead doesn't care. If there's
Well,
a
and other franchises, they don't do that. I think notoriously Subway is one of those that they'll open one down the street from you in
right.
direct competition to you. So is that not a problem just because it's not a large enough name or
No, so we have in some markets are very saturated. Texas, California, there are a lot that marked in the
you mean
hundreds
of
of,
brokers?
yes, of brokers.
Yeah,
Um, you can open up next door to somebody. The success of our brand is really the individual.
right,
So Goosehead looks up and says, you know what? We're not going to give it territories. What we're going to do is say best man wins.
right.
So if you are competing, if another person decides to open a brokerage here in Reno, for example, and let's say they
Mhm.
decide to open right down the street from our office, that's fine because the success of our brand and the success of our business is really Lori, my wife, and I going out, talking to people and saying, hey, this is what we have to offer. And we win based on what we can do versus relying on the brand and brand advertising.
Right. And the other thing is it's not proximity required. That is, for
Correct.
Subway, somebody's going to drive there and get a sandwich. So it's people who's
Yep.
passing through and people who live nearby, where if you have two Goosehead offices right next to each other in Reno, they're
Yep.
still going to be drawing from the whole Reno area.
Yeah. Well, you actually
So
bring
there
up
wouldn't be
real.
the same kind of, you're not competing for literally the people down the street. You're competing all across the marketplace.
Yeah,
Yeah.
yeah. And as a matter of fact, you bring up kind of an interesting distinction. The industry itself has evolved.
Yeah.
Um, when you look up and you see the commercials for a State Farm and you talk, that's like a good neighbor,
Right.
um, because they're encouraging you to physically come to their office, sit down. Insurance has evolved to a point where you can talk to me on the phone for a few minutes. I go through our very sophisticated rater systems. I go shop you against 80 carriers. I
Hmm.
find your option. I call you back, go over the options and say, great, you want that. I click a button. You get a DocuSign in your email. You check the box. I take payment. Now you have insurance. It's done seamlessly. We can do it over the cell phone. You can do it in front of a computer, and we no longer have that need for that physical geography or presence. I've got clients that are calling us and saying, "Hey, I'm in Europe, but I really need to take care of this." Yeah, not a problem. What do you need? Okay, here we have it already. Great. Here's the DocuSign. You have insurance. Enjoy the rest of your trip.
Right.
That's a new kind of flexibility that the industry is evolving to.
Yeah. Now, haven't we seen that for about the last 10 years as they're going away from brick and mortar?
Yes, yeah. You're seeing now a lot more online advertising. Some brands are going direct to consumer. They're trying to make it a point and click versus a let's have a discussion and sit down in an office over coffee.
Right. Yeah. I can't think of the last time I sat down with my insurance agent.
Yeah.
Yeah.
It's probably been 20 years. So,
Yeah. Yeah.
yeah. And
It's
other than that, I mean, we conduct business over the phone and sending DocuSigns and emails. And,
You almost
yeah.
have to call them once a year just to make sure they're still around
Yeah.
because there's no need unless you have a claim.
Yeah, yeah.
yeah.
Yeah, that's really, you insurance, you really want to not have to talk to your agent and not have to talk to that company insuring you because if you do, it means there's a problem.
Right.
Um,
Right.
the ideally you get somebody like when, our policies come up for renewal, our system flags us, there may be just general, um, adjustments in pricing that happen, inflation. But for the most part, I mean, if it pops up and you need it reshopped, we reshop it online. You get an email saying, hey, here's your new rate. You're okay with it. You click a button and you're done. You don't really have to talk, but it is good to periodically check in. A lot of people get very complacent with insurance. And I see this a lot, even with like clients that you probably have, investors that, they've got insurance, they've been using it for a long time, out of sight, out of mind. 1, 2, 3, 5, 7 years start passing, and they don't really think to go look. And the reality is that it's a competitive marketplace.
Right.
It's not a fixed price that's the same for everybody. These carriers are always competing for business. They get what's called, their appetite loosens, which means that stuff they want, and they get competitive because they're like, well, we need more business, so let's adjust our pricing and our risk pool. And a lot of people don't think to go contact a broker and say, hey, you think you can maybe take a look at everything and let me know how I'm doing? You may be in a good position and we'd let you know. But on the other hand, we may find out that, hey, listen, your coverages are out of whack. It didn't keep up with inflation and kind of how, real estate has evolved. So let's make some changes. And by the way, I can save you a couple grand a year. And
Well, that
Yeah.
just happened to me. My insurance agent in Tennessee called me and said, well, we're reviewing all your properties, and by the way, you're underinsured.
Mhm.
So we started looking at the values of the properties, the replacement cost per square foot, and all that stuff. And sure as shooting, I was $100,000 to $200,000 underinsured on a couple of
Yeah.
my properties, and I go, wow. So if I had a claim or a problem, I would have only gotten maybe 50 cents on a dollar,
Yeah.
and I would have had to write the check for the difference to rebuild, and that would have been not fun. So
Bingo. You hit on probably the most important piece of understanding that.
mhm.
When there's that shortfall in valuation, guess who writes a check?
Yes,
You. And
yes,
most people don't think of it. They think, oh, wow, I'm underinsured. Oh, well, wait a minute. If it's 600,000 to rebuild your house and you're only getting 400,000, you have to go find that money.
yes.
Otherwise, you're not getting your house rebuilt.
Correct.
Right. How often should somebody check back in with your insurance agent?
Yeah, you know what? It's something that, there's a strategy around it. Do
Yeah,
not
that's what I
go,
want to hear, the
yeah,
strategy.
do not go out and reshop and change your insurance carrier every year. That
Right.
works against you with the carriers. They view that as a risky behavior. So they
Right.
tend to put you on a higher risk calculation and your insurance ends up costing more. Ideally, every 3 to 5 years,
I was just going to say that
yeah,
three to
go
five.
look.
I was going to say 3 to 5 years. Am I correct?
Yeah, yeah, absolutely. Bingo. It's like you've done this for a while.
Okay, Kevin. So when a consumer, I'm going to ask about investors next, but for a
Okay,
consumer, when they're looking at insurance, what should they be looking for? I mean, obviously, it needs to be a policy that's going to cover the full value of their property if it
right.
burns down. But what else
Yeah.
should they be looking for in a carrier?
So there's a few things you want to look for. You hit on the most important. This is the one that gets talked about being underinsured.
Right.
It's the what's called coverage A. It's your primary structure coverage. That all the carriers use what's called a replacement cost estimator. It's software that when you call us and say, "Hey, I want to insure this house or this structure," we go rebuild it in software. And it comes back and says, based on that region, based on material costs, based on what we know about that market, to rebuild that structure will cost you $452,000 and that's their number. They base their coverage on that number. So we have the flexibility to adjust that a little. We know that, the finishes are really nice. They've got some unique things about that property. Let's insure that one at 525,000. That's how we set. That's a very important number because that dictates what you're getting a check for if you get a total loss.
Right.
The second most important and something that's often overlooked is the personal liability coverage.
Mm.
Most people don't think about that as being that important a number because they're thinking of it in context of, well, it's my house. It's not like I have people over. What's my exposure?
Yeah,
Well,
is that if you fall down the stairs, or is that if your friend falls down the stairs?
it's for if your friend falls down the stairs.
Okay.
And here's the important part. That coverage follows you, the insured, anywhere in the world. And that's the piece that people don't understand about looking at that number carefully.
Now, what do you
So,
mean it follows you anywhere
yeah.
in the world? Does that mean
So,
if your friend trips and falls out in Uzbekistan, then
no. So when somebody's on your property, at your house, you have a
okay,
party, they trip on the step, or better yet, more likely, a neighbor comes up to the front door to come ask you something, trips on a crack in the walkway, and ends
yeah,
up suing you.
yeah,
That insurance kicks in. But let's say you're out, you're traveling, you're at a restaurant in another city, and you set your briefcase down next to your table. Somebody walks by, their foot gets caught on that, they fall down, they break their hip. Oh my God, it's a tragedy, and they're very upset. And they're now going to sue you because of all the pain and suffering you caused. Your homeowner's personal liability coverage follows you. So it's not you going, oh my God, now what do I do? Your homeowner's policy kicks in to defend you against that personal claim. So
hmm.
when I say it follows you from a liability standpoint, if you're the cause of something anywhere, that coverage kicks in.
So
So
if I punch somebody in the nose in Vegas, does that cover me or?
No.
no, because you're initiating something
Oh,
there.
okay.
You
That's
need
not
you need an
It
accidental.
has to
attorney
be
to get out of
reactive.
jail.
Yeah, exactly. There you go. But so here's going back to what's important to look at. That number is typically a round even number. People typically get $300,000 of liability coverage or 500. You can get up, even more in some carriers.
Yeah.
Um, a lot of people don't think about it and say, well, I just have 100,000 of liability coverage. That should be fine. Well, if you look at somebody, and this starts spilling into if somebody has personal stuff and investments, what do you think an attorney is going to look at when they decide to sue you? They're going to look up and say, wow, this guy just caused an accident. And man, look at the car he's driving. Boy, that's worth 80 grand. And let me see, look at, he's got a nice house. And oh, he has 3 investment properties. We're suing that guy for $1 million. That's why you look up at that number and say, that's a very important piece of it. Now, here's the crazy part. The difference between 100,000 or 300,000 and getting $500,000 of coverage is works out to less than a cup of coffee like a week. It's a very small number to adjust that and get appropriate coverage. But often agents don't talk about it, or people think, oh, it's going to cost too much to get $500,000.
Okay, here's the leading question. What about an umbrella policy? Now, as an investor, for me, those are really important policies to have. To put an umbrella over your existing policy and increase your liability coverage and some of the other things. Can you speak to that just a little bit?
Yeah, absolutely. Everybody should have an umbrella policy. Let's just start there. Now, why? So, an umbrella policy is just an extension of like personal liability. We'll talk on the personal side right now. Its coverage is measured in $1 million. So people think, oh my gosh, I can't afford $1 million extra policy. Well, that $1 million extra policy is a few $100 for the year.
Mm-hmm.
Not very expensive. This is how it works. A typical person has They may have their home insurance. They may have a car. They may have some other things that are insured. That liability policy, which is what an umbrella is, it lays over the top of all those underlying policies. So if your car, for example, you have $250,000 of liability coverage on that car. You now, with an umbrella, have $1,250,000 of liability coverage. So if somebody sues you because you caused an accident, you're going to have a big settlement. That policy kicks in once that auto policy runs out. 250,000 comes in, and then that next policy kicks in. It extends to everything. Now, you brought up something as an investor. This is an important distinction for your viewers. On the personal side, you can get an umbrella to cover all of your personal policies. But if you have an investment property and that's being held in a company, it's not you personally, that personal umbrella does not extend over those properties. You have to get that company to get an umbrella policy. And then those policies for that company are now covered.
Okay, so for example, I have property in Tennessee, and then I
Mhm.
have an investment property in Mississippi. Can I
Okay.
get an umbrella? And it's a different policy, a different company that's insured in Mississippi. Can I get a policy umbrella to cover all of those, or do I have to get a separate one for each company?
So it's um, you get that policy tied to who's the owner, who is the insured. So let's just say for conversation, you have an LLC that owns both of those properties. You can get one umbrella policy that would extend over all of those holdings,
Even
no
in
matter
different
where they are.
states?
Different states and
Okay.
even different companies.
Okay.
Um, there are umbrella companies that they don't care that you have a policy with Safeco and another one with State Farm and another one with whoever. They're overlaying as long as it meets their criteria, which is it's a simple formula. The liability portion of all the underlying policies have to be at a minimum. So typically it's 300,000 is kind of the floor.
Mhm.
We encourage everybody to get 500,000 because the price difference is not that much, but you're now very solid. And it allows the umbrella policy to be at the best pricing. The higher
Right.
the liability for the underlying policies, the lower they price it.
Because my
Okay.
my portfolio is owned in a trust.
Yep.
So all the properties are in a trust, even my personal.
Okay.
So would an umbrella, so I would probably have to have two umbrellas, one for personal and one for the investment properties, or can one umbrella cover both? Because everything is owned in a trust.
Yeah. So you can probably get away with one umbrella because it's not necessarily the use of the property as much as it's the ownership.
Oh, okay.
So if you have a property that's an investment property, you don't live there, but you own it, that's fine. They just want to make sure that, okay, well, are we applying that coverage to the same owner across all those policies? And if everything is in a single trust, then that trust gets named on those policies, and now it extends.
Okay, that makes sense.
So go back to my previous question of what are the primary things that a consumer should be looking for in insurance?
Right, right. So once you get past the property coverage
Yep.
and the
And
liability,
liability.
you've got to look at the individual needs. Like, do you need loss of use if you get displaced? Yes. Um, there are coverages that you can get if, for example, you're in an HOA or you're in a condo that you might get an assessment. and there's coverage that can kick in to help cover that. So it's not necessarily all out of your pocket. It can be covered through your homeowner's policy.
Okay.
Um, Outside of that, it's really the important part of the relationship between an insurance agent
Hmm.
is they really should understand your whole risk profile.
Right.
Often we get caught up in, hey, I got a house, I need insurance. Great, can do that, real simple. You're probably well covered, but it's more important that I understand, oh, you have these things, you do these things on your personal time. Believe it or not, if you have high risk hobbies, you're a skydiver or scuba diver, it impacts your insurance. You can look up and go, oh my God, they found out that I was a skydiver and I didn't disclose that. Um, Understanding you as an individual, your assets, really helps figure out the right coverages. Most policies, as a standard, include pretty much everything you need. It's the limits that you've got to go look at. Most people, here's one that
Right.
we get all the time. Hey, I've got a homeowner's policy and I've got a gun collection. All of it's covered. I'm like, well, what's the value of your guns? Well, shoot, God, I've got one that's worth $2,500. I probably have $30,000 in weapons.
Hmm.
Um, oh, well, your homeowner's policy caps out at $2,500. We have to make adjustments to that. People go into it thinking all my
Are
stuff,
you talking about personal property?
personal property,
Okay. So
and
personal property caps out at 2,500 usually.
depending on the type. Yeah. So
Yeah.
there's it's pretty extensive. Every policy has limits on all
Right.
the various categories, but
Yeah. And the
that's
limits
something
are, this is what it'll go up to. Yeah. Am I understanding
correct.
it correctly? Okay.
Yeah. So even though you may have let's say you have $500,000 of personal property coverage,
Yeah.
by line item, you may cap out. Like even though you've got 500,000, if you say
Oh,
I lost all my guns, they go, oh well, that category we actually cap out at 2,500. So you're
right.
only
Right. Right.
getting a
Right.
check for that.
So you want to
So if
make
Um,
you
sure
have
that you,
jewelry in the safe and it
y-
burns down and melts,
yep,
you only have
that's
like
another
maybe
one.
$5,000 coverage opposed
Yes.
to you got $50,000 worth of jewelry in there and
Yeah.
gold. I mean, people are putting gold in their safes now.
Yeah. So
Tangible.
that's something. Well, here, you guys are all about strategy and really, focusing on that.
yeah.
That's another strategic piece of insurance that people should know. Let's take jewelry for example. Um, if I have most people that have jewelry, when you look up, they think I don't have much jewelry. I shouldn't worry. I go, oh, well, what's your engagement ring or your wedding ring? What's that wedding set worth? Some people look up and go, wow, God, I never really thought about it. It's $20,000 worth of that. Um,
There are people who have $20,000 rings.
yeah, oh yeah.
Oh, that's
Imagine
cheap.
if you have a Rolex or,
Man, I
That's
grew
those
up in
yeah,
the
kinds of things.
wrong
that's cheap.
somewhere.
Just
So
an inexpensive Rolex is 10 to 15,000.
yeah. So people think like, yeah, I've got coverage. Here's the strategy around looking at the particular line items. If you have a claim on, let's say something happens and you file a claim on your homeowners for a piece of jewelry, that claim now gets recorded on your homeowners and follows you.
How long does it follow you for, by the way?
At a minimum 3 years, some look up to 7 years.
Okay.
So here's what
Meaning
happens.
some when you're changing insurance companies, they'll look at you back 7 years
Y-
or up to
Yes,
7 years, depending
yes,
on the company. Okay.
So
yep.
one recommendation I would do, and I've started doing that, is photograph everything. Take your jewelry, lay it out, and take a picture of it.
Hmm.
Take your stuff, lay it out. Take your guns, lay it out, and take a picture, and archive it somewhere in the cloud or in Dropbox
Yep,
or whatever. Because if you ever have a claim, it's he said, she said, and once it's all melted and infused, and you can't tell what it is, there's no way to establish a value. It's
correct,
and
correct.
and so and here's the scary part that happened to me. My neighbor's house in Tennessee burned down last week.
Oh no.
Yeah. So it was a freak thing. It was a lightning strike, hit a tree, affected the gas line in the area and the ground wire, and that's the only thing they can attribute to it. A tree went down, severed the power line. Power company came up, reconnected the power line, charged it, and then with that charging, it created a spark or a fire or something in the house, which they didn't know. And the people weren't home. It was their second home, so nobody
Oh
was
wow.
home. Burned it to the ground, literally. Right, there's nothing left. So that is a huge eye opener because act of God, things just happen.
Yeah. Yeah.
And that was right
So
next door. So
you hit on something, take it in, when you think about Northern Nevada, for example, we may get a wildfire, something crops up. California, same thing.
Wait,
We
wait, wait. Isn't that someone clearing out the tumbleweeds?
Yeah. Right,
with a
right. Yeah,
blowtorch.
but often you don't have time to go do something. So taking the time to document things ahead of time and storing it somewhere off site, very good advice. But let me get back to that jewelry example. Like you
Yeah.
file a claim with your homeowners, it follows you. Most people don't know as a strategic play that you can go get a jewelry policy
Mhm.
Mm-hmm.
specific to your jewelry. Here's the benefit of that. One, the coverage is multiples better. You can say, hey, I don't even know what happened. My diamond fell out and now I need it replaced. Those policies are like, not a problem. We'll get it done for you. But here's the beauty of it. They don't report to the central the clue, which is kind of the tracking of claims in the industry. So that event never happened. So when you go to get, hey, I'm moving, I need to get new homeowners insurance, they have no idea you filed a claim. So your
Right.
homeowners policy stays low. You get better coverage for about the same amount of money. And it's all built around strategy of looking at your whole profile and making sure that you're getting the right pieces. Tying back to our conversation about, well, what's the difference between a captive and a broker? Well, a captive, when you go to a State Farm or AAA,
You make it sound so appealing, Kevin.
yeah, well, it is because guess what? They're going to say, just do your jewelry with us, just
Right,
do
right,
everything with us. Well, guess what? Now, when you file any claim, they know.
right.
Now, no matter what you do, it's following you. When
Okay,
you
so
have a,
yeah,
go
this is
ahead.
something I've run into. So we had a client that the year before they sold their house, they had a leak. It was when they weren't there. They came back, a day or two later. So there was a flood in the house. I think one of the pipes burst in their bathroom. And so they had, $10,000 in claim or whatever to replace it. So they
Right.
sell their house the next year, and the buyer's having trouble getting insurance because they had a claim on their house.
Yep.
Now,
Yeah.
I think
Clue
of it
report.
as a human. And I think, well, what's the chance of this happening again? I mean, it's the same as in any house at any other time. But how do the insurance companies look at that? Because it doesn't sound like they look at it the same way as like, okay, this is a one-off that may
Right.
never happen again. But or they just look at it, well, okay, it happened once in this house. There could be a faulty plumbing throughout the house, or how do they look at it?
Right. So the general rule of thumb,
Yeah.
the way the insurance companies look at it, there's a database out there. They call it Clue. It's managed by LexisNexis for the insurance underwriting world. Anytime a claim is filed on a property or an individual, it gets reported. So when an insurance company says, "Hey, I want to see what happened at that address," they
Hmm.
can see an event.
Right.
This is kind of how they view it. They view if there is a $25,000 or more claim, it hits their radar and they have some concerns and they'll take a really hard look at that risk. If you have two claims of the same type within a 3-year span, for example, had two water claims,
Hmm.
most insurance carriers won't insure it
Okay.
because they look up and say, the odds of two water claims happening on the same property twice in 3 years means there potentially could be a fault in the system or something's wrong. So they view that as risky.
Okay.
If you have multiple claims of different types, that gets their attention. They understand life happens. Hey, in 3 years, there were two claims on that property. One was from wind, a tree went through the window. The other one was a pipe burst in the dishwasher and flooded the kitchen. They'll look at that detail and say, you know what, we're okay with it. But when they see a pattern or they see something that checks a box in those basic metrics, that rule of thumb, that gets their attention to look at more closely. Now,
Then, yeah, how do they address that? Do they just say no? They say maybe? They say we'll charge you more, or all the above?
this kind of all the above, but it's really based on let's go up to 10,000 feet. Got insurance
Yeah.
company A, insurance company B. Insurance company A is well established in the neighborhood. They insure lots of properties. They know what they're into. And now they start seeing a property that comes up. Somebody sells it. Now they're being asked to quote it again. And they see, wow, there's a lot of claims on that property. They could look up and say, you know, our risk pool in this area, we're going to opt not to do it because our risk pool in that geographic area and the mix of risks that we have,
Hmm.
um, we need to manage that from an actuary standpoint.
Right.
Company B is saying, hey, we're brand new there. We're competing. We want to get business there. They may overlook it and say, you know, we're okay with those two claims. We're okay with it. We'll just go in and price it. They don't necessarily go, wow, there was a claim. It costs twice as much. They really analyze the details of it. You know, it depends on the type of claim. If it's like the example where high winds and tree went through the window, well, they'll look up at their weather data and everything else and say, you know what? That area is very susceptible to weather events. It has
Hmm.
often has storms and high winds. That most likely will happen again. We're going to price it based on that risk. And so they do factor it in, but it's not kind of a direct one-to-one, but they're
Okay.
looking at that as a whole. And in general, I mean, here's the biggest message that the insurance industry did to itself, but this is what people need to understand. Insurance is intended for catastrophic losses. It is not a home warranty policy. And
Hmm.
people over time have started treating insurance like a homeowner's warranty.
Right.
Cars. Hey, look at that. My God, somebody opened their door and dinged my door. I'm filing a claim, so they'll take it out and do the touch up. Pay for that yourself. Don't get a claim on that. It's intended for when an accident happens.
Hmm.
When your home has I'll use the dishwasher example. Oh my gosh, I caught it, but boy, there was some water there. I've got to redo a part of my floor. Boy, it might cost me $2,500 to get that piece of floor redone. People automatically go, I'm filing a claim. The vendors, the contractors see it as an opportunity to make money. Oh boy, we're gonna have to replace the cabinets and everything. You can get a new kitchen out of it. They
Hmm.
push it through. They give quotes that say there's catastrophic, damage, and people take advantage of that system instead of just saying, I got to bite the bullet and write a check and take care of this myself.
Well,
So
who wants to be responsible after all?
yeah, yeah. And that's the big problem we have. Um, Once you understand that, and you start operating that way, all of a sudden your rates and your treatment from carriers gets better. They look up and say, you're not a person that files a lot of claims. We
Hmm.
like your behavior. You're not a
Right.
person that does things frivolously. We like your behavior. When they look up and go, this guy filed 7 claims in the last 5 years, all of them were $200 claims. We don't want that guy because he's just looking for us to pay the bill all the time.
Yeah. 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 What's the difference between like, we talked about the consumer, what they should be looking for. How is it different for investors? what should they be looking for in an insurance policy that's in addition to whatever the consumer is?
Yeah. So on a commercial policy, like, well, let's say you're an
Okay,
investor, an
we're talking
individual.
residential investors.
Okay.
Yeah,
So I'm a
so
residential investor.
yeah, Mike and I both have properties.
Right.
Yeah,
Okay. We'll talk in the context of that.
yeah, thank you.
When you're looking for policies, you want to make sure that you have some additional coverages that are typical in dwelling policies. But your interests are, hey, what happens if I have a claim, some damage happened in the kitchen, and now my tenant is displaced or they decide to move out, and now I've got lost rents. There's ways to structure those policies to give you coverage for paying for people having to be relocated for a time while things are being fixed, or giving you coverage for lost rents because that damage created a situation that now I have to cover my mortgage, but I don't have a tenant.
Are those additions to the policies affordable?
Yeah, they are. They're not very expensive because at the end of the day, the insurance carriers know statistically, it's not like everybody claims are happening every day and everybody's displaced and I'm paying rent for everybody. They know that's not really the case. So it's not terribly expensive, but it's something that there are lots of pieces of a policy that as an investor, you should know about. And
right, yeah. So what are the other additional pieces? One would be that you could cover rents if a tenant is displaced due to, I don't know, something that
It's
happens to the property that needs to be
it's basically a
claimed.
loss of rent
yeah,
policy.
yeah,
And sometimes, now correct me if I'm wrong, but sometimes they're already written into the policy to begin with.
yeah, they are. And that's what I mentioned. So there's high level for somebody
Right,
doing residential investments and living their life on their personal side.
right.
There's a homeowners policy, an HO3, which is intended for a residential house that me as the owner, I occupy and live there. That type of policy is called HO3 or a homeowners policy.
Okay.
If I own a residential property, but I don't live there, it's something that I am intending on renting out and it's an investment. You don't insure that as an HO3. You insure that as a dwelling policy or a DP3.
Okay.
The big difference in those policies is primarily personal property and some of those other lost rents kind of features of the policy.
So that
Um,
is in investor policy, you won't have the personal property inclusions.
Correct. It typically defaults. So on a homeowner's policy, it defaults to a percentage of the value of the home. And it's usually a big percentage, anywhere from 20 to 50%. So if you've got a $600,000 property, you may have automatically $300,000 of personal property. You can change that number, but it defaults.
So yeah, really quick. So did that make that policy a $900,000 policy? Because
No,
you have replacement
no,
and then you
no, it
have personal
makes
property in addition to the
replacement
replacement.
on the structure of
Yeah,
600 and
yeah,
all your stuff of 300. So you,
right.
in theory, get 900,000, but they're treating each component of that. Personal property is a maximum of, and the structure is a maximum of.
Okay.
Now, on a dwelling policy, my investor, house that I'm renting out,
Yeah,
that personal property defaults to like 5,000. Why?
right.
Because typically you're renting it out vacant and the renter should go get renter's insurance and cover his own stuff.
Yeah, it's somebody
Now,
else's personal property.
right.
Well,
Now
yeah,
here's an important, yeah, go ahead.
and the 5,000 would cover like your stove, refrigerator.
Correct.
That would be classified as detachable, freestanding personal property
Correct.
for the
So
landlord. Yeah.
So you bring up a good point that a lot of people don't think of. Let's just say on that property as the landlord, you got a big yard and you happen to have a shed and you're storing lawnmowers and other equipment. And maybe you have some, repair equipment or tools that you keep at that property. you want to make sure you're covering that in that personal property component. The other one that often is, people have an oversight. What if you rent out somewhere that's semi or completely furnished? You need to account for that like you would your personal home. Go add it all up, because if something happens and you only have $5,000 of coverage and there's a fire and you lose couches and TVs and anything that you have in there,
Right.
you could be underinsured.
So
So
think of a
that brings,
short-term rental in that
yeah, that would
respect,
be, yeah, the
Correct.
Airbnbs, VRBs. Okay.
Yes.
Yeah.
Yeah.
or a long-term rental that's rented with
Mm-hmm.
furniture.
Right.
Yeah.
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 All right. So another question about investors and insurance. So I had a property bought in May last year. It was November before we had a tenant in it, and we were doing a lot of work on the property. Is there a separate policy that I should get or that should be gotten during that time of repairs and getting it prepared for the renter?
Well, yeah, that brings
Yes.
up a good point because you have a vacancy time frame, and if it goes vacant for longer than a certain period of time, the
Yeah.
policy is not effect. Am I
Well, this is a new property
clear?
that I just bought, but
Right.
Okay, so
yeah.
let's take that example. I buy a new property. I need to insure it, but I'm gonna be doing some improvements and things to it before I put it on the market.
Yeah, it's gonna be vacant for 5
Yeah,
months.
that interim period, what you want to get is what's called the builder's risk policy.
Okay.
Those are designed to protect you from liability, to protect the structure that's there, some of the components, like you may have materials on site that could get stolen if you're doing something. But
Depending
it's
on where you're at. Where
right. Yeah,
what
exactly.
part of the city you're working in?
Yeah. So you'd want that because it boils down to the fundamentals of insurance. They look at what's the use.
Now,
And
does that also cover, sorry, does
yeah,
that also cover the contractor comes in or one of the subs cuts their hand off with their saw or nails their foot to the floor? Is that cover
yeah,
that kind of stuff as well?
there's a
Or
liability component of that policy to protect you
okay,
should you do something. Now, here's what the insurance industry is going to do. They're
right.
going to look at that scenario. You're going to call up and say, "Man, so the contractor was in there. He cut his hand, and now I'm getting sued." You, the attorneys representing you for the insurance company are going to turn around and go, "Well, let me go back and look at the situation. What was the cause of that? Oh, it was an employee of contractor ABC
Yeah.
that got himself hurt. That's not me. That's your workman's comp, ABC
Mm-hmm.
contractor. You need to
Uh,
cover that." And
uh,
there'll be a argument back and forth of what's the cause and who takes responsibility.
I agree. I completely agree. And I know that that's what, if that happened to me, that what my attorney would do. And also firmly believe that the attorney on the other side would go, yeah, you're the homeowner. You're responsible for this dwelling. And this happened in your dwelling. So you're on the hook too. So
That
how that,
that's so this is you 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 spilled into like a whole nother topic of how the industry is why it costs so much for insurance, because what's
right.
going to happen is they're going to argue. Now let's take that scenario, but two different paths.
Yeah.
One is, hey, I got my hand cut with my saw. I had to go down to the urgent care. I got stitched up, and man, I don't want to pay that medical bill. All insurance companies go, you know what? Put it on your med pay. We'll write you a check. We're done. Take that same scenario, and all of a
Now,
sudden,
wait. Which insurance company? The employees, the contractors, or the homeowners?
now in theory, it
Because if
should
the
be the employer of that individual that should be covered under his workman's comp or covered under his policy. If somebody's successful in arguing, and your insurance says, mea culpa, we give in, you may cover it on. There's a component of most insurance policies called medical pay,
okay,
or med pay. It's a small amount. It's 5, 10 grand. Everybody goes, well, why am I paying for that? It's included. What it's intended for is, I cut my hand at a party, or I cut my hand and I needed an urgent care thing, and there was a $1,200 bill. it gets paid out of that. And everybody
Sure.
says it saves a lawsuit, it saves a bigger thing. That's the first path we went down.
Right.
Should be the employers, but could be yours. At the end of the day, it's a very minor thing that everybody wants to go away. Take that same scenario. Now this guy says, I cut a tendon in my hand. I can't work anymore. I'm suing you for $500,000,
Exactly.
which is what most likely will happen because an attorney's going to go after the big dollars.
Right.
The reality is that your insurance company is going to fight tooth and nail that that is not your responsibility because
Right.
it was an employer's negligence in training, not the physical location that he happened to be. It wasn't because of something you did. It was the contractor that had a board on the ground. He tripped while he was sawing. That's not you. And that argument will go back and forth. So it's not a cut and dry because good attorneys can get crazy settlements. I'll share with you one in a minute that's like, really? And that's when you realize, like, okay, wow, it really just depends on how good your attorney is. Now, I'll
Very
give
much
you a
so.
scenario that's will illustrate this.
Right.
Last year, I think it was in 2025, somebody was driving through a Starbucks. He
Driving
ordered
through a Starbucks.
driving Starbucks drive-through
Okay.
to
Thank you.
order
I'm thinking
a
crash.
hot tea. He ordered a tea. The employee put it in a drink carrier and handed it through the window.
Hmm.
When it got through the guy's window, the cup fell out, spilled hot tea in his lap.
Hmm.
The McDonald's
I was going to say,
scenario,
it's a
right?
McDonald's
Yeah, well,
scenario.
that's also happened at McDonald's. This one happened to be Starbucks.
Hmm.
Take a wild guess at what the settlement was for that.
I have no idea.
$51 million.
Oh my word.
That's
It's
an expensive pair of pants.
Yeah, it's unfathomable, but that happens all the time.
And
And
they had to pay it, and he collected
yeah,
it.
well, I don't know I mean, that was what the settlement and award was. I don't know if they ended up negotiating it down to some smaller number, but that's what happened. So you take that and look up and go, that's ridiculous. What should have happened is somebody should have said, hey, I'll buy you new clothes. Sorry it happened. Hey, if you need to kind of go to the doctor, maybe you got burn mark, whatever, we'll pay for that. Should have been a few $1,000s problem that unfortunately, with a good attorney, ends up being a $50 million claim.
Well,
That happens all the time.
yeah. Yeah. And I wonder if it's not
Mm.
the combination of a good attorney and a bad attorney. There's a
Uh,
good attorney on one side and a
yeah,
not
I
as
would I would
capable
think
attorney on the other
Starbucks. I
side.
would think Starbucks has a really good attorney.
I
yeah.
would think so too.
Yeah.
Yeah.
So it's circling back to your question, like, well, whose responsibility? Well, if we use common sense, it's pretty straightforward. All of this stuff is almost all solved with real common sense. The reality is, yeah, except in Nevada, we don't have caps on tort awards. It can be anything. So in our state in Nevada, it's a problem. You go to some
Mm.
other states, they control that. And guess what? They don't have as many lawsuits. They,
And that was going to be my next question is talking about common sense. How does the legislative aspects fit into this? So you just mentioned that you don't have a cap in
Nevada.
Nevada, but like California, Arizona, New Mexico, I mean, are these make sense states for insurance, or are they less so?
Yeah,
That,
some are make sense. Um, Here's the reality, and I don't mean
yeah.
this as a knock against any profession. We have a very strong legal lobby. There's a lot of
Mhm.
attorneys out there very strong that they are able to protect things like their ability to go sue with unlimited claims and all of that.
Okay.
Um, that's great for them. Here's the problem in general. And I don't have the exact number, but I got it close. If you were to count all the attorneys in the world, all of them, take a wild guess at what percentage of all the attorneys are in the United States versus every other country in the world.
Oh, you mean Worldwide, what percentage is the United
Worldwide
States? I'd say
percentage,
80%.
you're bingo. 80% of all global
Attorneys.
attorneys are right here in the US. Why?
Mm-hmm.
Because we are a very friendly country and every state is unique to allow somebody to go in and argue. And if they're good, they get a big payday. That's why there's
And
so many attorneys. And that's why there's so many claims. And that's why insurance is costing so much because we've got all of these factors throwing at a carrier. Hey, you got to pay the bill. You got to pay the bill. Eventually they go, well, guess what, Joel? You're going to have to pay a little bit more in premium to help pay for those bills we keep paying.
Yeah.
and 50% of that 80% is in California.
Yeah.
I don't know. I don't know if that's the number, but it's huge.
It is almost like that. It is a pretty significant number.
Yes.
So yeah, I mean, it's kind of crazy going back to kind of how do carriers treat all this stuff?
Yeah.
Common sense. You and I could run a very profitable company if everybody used common sense. But at the end of the day, when you've got those factors coming in and those ridiculous settlements, it's kind of hard, that
Yeah.
now everybody's fighting to point the finger.
Yeah. Do you
Mm-hmm.
see any kind of insurance reform actually happening?
You know, there's so in the last few years, and California unfortunately has led this, that has woken up the entire U.S. in terms of insurance. We'll talk about wildfire and environmental catastrophes.
I'm glad you got there. I've been meaning to point in that direction. So I want to hear your observations and how it's affected the industry as a whole, because I can only imagine that you burn a city down, it's not the city that pays, it's everybody that pays.
Yes, yeah. So let's talk high generalities.
Mm,
Years ago, um, when there was a wildfire, there was a major event, the FEMA tracks that stuff.
mhm.
They look up and they count one event. Let's say there was a hurricane or a wildfire or a flood or something. That one event, if there's more than $1 billion of damage and claims associated with that one event, they count that as one.
Okay.
Historically, from 1980 all the way up into the 2000, early 2010s, 15, 2018. On average, nationwide, we had around 3 to 5 events that would exceed $1 billion and get counted as one. So
In a year
in a
or
year.
okay.
So any year we had 3 or 4 or 5. That's it.
All 50 states.
Yep. All 50 states combined.
Okay.
The last 7 years, for example, every year we're having between 20 and 26 billion-dollar events.
Mm.
Now, when you say that
Mm-hmm.
20 to 26 billion dollar events, you mean the Paradise Fire is counted as one event,
Correct.
not a
That
that's
group of
one,
fires is
right,
one.
is one event. And
Right.
so, right, you're only saying there's 20 to 26 that are surpassing the billion mark, not how much past a billion it goes.
Correct. So
Okay.
here's the crazy part. If it's a
Yeah,
$900 million event, it doesn't count as anything.
right.
So all of those are happening as well. So when you look at all of that, you look up and say, wow, we're evolving in insurance where all of a sudden the industry didn't pay as much attention. And then we had the Palisades and Eaton fire. It was a perfect storm. There were a lot of things that came together. There's something called conflagration in fire.
Mm-hmm.
Conflagration effectively means I've got one house here and one house here. They're 10 feet apart. And this one catches on fire. The heat, the embers, the sparks from that cause a domino effect. All the houses start burning. That kind of reaction is called conflagration. Doesn't normally happen in a wildfire. Wildfire happens, an ember blows, it might catch somewhere, a neighborhood a mile away, and that's kind of how wildfire behaves. Nobody ever thought in a million years that Pacific Palisades, with their brick buildings and historic buildings, would burn to the ground. And they lost a lot. I mean, the estimated losses there were somewhere in the, they estimate around $50 billion in structures.
Right. Now, you saying consumers lost that or insurance companies lost that?
That's the value of lost property.
Value lost
So,
property. Okay, so
yeah,
the consumers lost
right.
50
So
billion.
consumers.
Right,
So now everybody's looking, I'm going, somebody has to rebuild my house or
right,
rebuild my business.
right.
Um, that really hadn't happened. When we had wildfires, it was devastating and we lost houses, but nothing to that level. I
Right.
mean, um, they lost well over 6,000 structures.
Well, Santa Rosa was pretty catastrophic, and the Paradise
Yeah.
Fire was
And
also pretty
and
catastrophic.
historically there was a handful that all of the industry, all the firefighters and everybody that talks about it, they all talk about the campfire fire and
Yeah.
all of those handful.
Do you have any observations at how we're getting so good at fires?
Yeah, about 80% of them are caused by humans. We got a lot of firebugs out there or electric lines that are causing them. It's not natural phenomenon. Um,
Right.
but so take that event. What happened was the rest of the industry went, uh-oh, look at the loss. And we never thought that could happen. Maybe we all need to start looking at it. So we now look up and
Yep.
everybody's
Hold
concerned.
on. When you say rest of the industry, what do you mean? Do you mean auto and farm workers? Do you mean like all
So,
these other types of insurances, or do you mean just all the companies that weren't necessarily in California and directly affected by the fires?
a little of both, mostly about the companies that were in California.
Okay.
Never thought like, do I need to worry about wildfire in Louisiana? Well, yeah, we know it happens, but oh my God, what happens if? And they
Right, right,
all
right.
started saying, well, one, we have to absorb, you were saying who pays for it? We
Yeah,
have to absorb helping cover that.
right.
And two, what happens if that happens elsewhere? Maybe we need to start adjusting our pricing to account for things that we never really thought could happen, but now we see evidence that could.
So what you're saying is California is exporting something else.
Yes, they are now
Higher
exporting
insurance rates because
higher
it
insurance
happened in
rates.
California. It could happen in Colorado or Louisiana
Yes.
or somewhere else.
Yeah,
Okay.
and here's something kind of interesting. I just saw an article yesterday came out in the Insurance Journal. Um, they're citing wildfire as the most significant escalating event nationally when it comes to claims exposure and risk. They're on
Mm.
average it's a premium impact of 12% per year that's growing, that comparatively to other things is usually a couple points. So,
So
so go ahead.
yeah, do you feel like the insurance companies are over the next couple of years? Well, I have to ask because realistically, you have a $50 billion fire that's going to affect some carriers in a major way.
Yeah,
And my understanding is you have a block of money that's held by the insurance company. And if you take a big dip in that, then they have to cover it by increasing premiums to be
correct.
able to fill it back up. And so if that 12% it is happening all over the nation and these fires don't happen all over the nation, then the insurance companies are going to be a little fatter. Their reserves are going to be fatter in years
Right.
to come. Do you think that we're going to see premiums go down, or you think they're just going to kind of keep them where they're at, or you think that
I,
attorneys are
I,
going to suck more out of it?
I don't honestly see premiums really dropping substantially, um, because of what you just said. Uh, you know, there's something that the insurance, and you have insurance because if your house burned down, you probably can't write a check for $750,000 and rebuild that house. You
Not
get
yet.
insurance to
Someday,
cover.
right?
Yeah, one day. Um,
Someday.
the insurance companies have the same thing. It's called reinsurance. They go buy insurance to help protect them. And what happened in the industry and why everybody's looking and why the rates are not going to go down substantially.
Mm-hmm.
Insurance company A buys insurance called reinsurance to say, hey, if I run into an event or something catastrophic and I have to pay out $20 million, that's my cap. Then I want your insurance to kick in and help me pay for all of that. The reinsurance market said, we're seeing far too many of these big events, far
Mm-hmm.
too many payouts. So guess what, insurance company? I'm no longer letting my insurance kick in at 20 million. I'm bumping it up to 50 million before I'm going to start paying. So you have to absorb another 30 million of out of pocket before we come in and start paying the bill. And the second thing they did is, and guess what? Our premium that used to be $1 to cover you at 20 million, it's costing us a lot more. So now it's $3.
Right.
And we're going to start insuring you at 50. Well, the insurance companies look up and guess what? Low man on the totem pole loses. Guess who's paying that difference in the form of higher premiums? So when that evolution is happening in the industry, I don't see that changing. Now, here's what I do see potentially changing. In all policies, earthquake and flood is not covered. You got to buy a separate policy for that. We
Right.
all understand that. It's kind of the way it is. The reality is there is no flood-free zone. Everywhere has flood risk, but not everybody buys flood insurance. And earthquakes, California, Northern Nevada. I mean, I just happened to look at an earthquake map before we got on, and oh wow, in the last week, just in Reno, we had a half a dozen earthquakes,
Mm.
anywhere from 1 to 2 point something on the Richter scale. But we don't think about buying that insurance.
Right.
I see the insurance industry starting to evolve like California did and said, you know what? We're going to remove that fire risk and we're going to make that a whole separate policy. It's not going to be part of your regular policy. That's the evolution. There are some companies and some houses, one policy will cover fire and everything, and other neighborhoods that they go, boy, that fire risk is high. So you go to the California Fair Plan for your fire and we'll cover everything else. I can see other states starting to adopt that trend. Go, we can't keep absorbing and raising prices to cover that risk. So let's bifurcate it. Let's look at them as separate risk pools and we'll price them differently. Nevada just passed a law last year, went into effect January 1, that gives the insurance carriers for residential properties, not commercial, but residential right now, that they can say, I am removing wildfire, that peril, from your policy. So if a wildfire hits, no coverage. But
Mm.
anything else happens, we will cover you.
But the insurance carrier, that's what you're saying, is you're
Correct.
allowing the insurance carrier to be able to remove sections of their policy
Correct.
and no longer cover specific sections of a policy.
Yeah.
In
Now,
this case, wildfire.
yeah. And that is an evolution. That's a response that Nevada did to California that they didn't want to see what happened a few years ago, where the carrier said, we had enough. Prop 103 started it. We started being controlled on our rates. Now we get into these wildfires. We can't keep up because you're not allowing us to adjust pricing.
Mm-hmm.
So we decided State Farm, Farmers, Allstate, Berkshire Hathaway, a whole bunch of them. We're no longer writing homeowners policies in California.
Right.
Went from could get insurance anywhere to, oh my God, I can't get any insurance.
Right.
Simplifying things, Nevada looked up and went, oh my God, we don't want that happening here. So they developed this kind of option for a carrier to start getting creative, develop a product for fire, but split it off if that helps you stay in the market instead of saying we're exiting altogether. And that I can see being looked at more globally as we look up and say, we can't keep absorbing everything on one policy. The industry is going to start changing.
Mm-hmm.
And
Well, that allows the consumer or the insured to choose if they
yes,
want coverage or not, if they're going to self-insure that specific item. they can determine their personal risk of that happening and either buy the policy and pay for it, or if it happens, they still have the other coverage. But if the fire happens, they have no coverage if they didn't get the policy.
Correct. Yeah,
And I think
that's real accurate.
that's a fair way, but it also is a way that the insurance company would have the premiums to cover all that, and the insured is going to pay for that.
Right. And it starts taking something that historically was a catch-all to now start making it more of a menu.
Right.
And it already
That's
exists. The reason I see that could be an evolution, it already exists. People get all freaked out, like, what do you mean wildfire's not covered? Well, guess what? Flood isn't covered. Earthquake isn't covered. You have the option of buying it if you want. If you're in high risk, it costs you a little more. If you're in low risk, it costs you a little less.
Yeah.
That could be a logical evolution.
Tornadoes are covered under the wind part of the policy, especially in
Right.
Oklahoma, Tennessee, Texas,
Yep.
wherever they have the tornadoes. But
Yeah.
I don't see a tornado creating a level one category of being $1 billion or more.
Correct.
They're
Those are,
so small, they're very specific.
yeah, they're very isolated. I mean, that's
Yes.
why it's a real risk out there. But that's, I look up and we write policies in Tennessee and Ohio all the time. And I look up and, it's easy to sit back if you've never lived there to look up and go, but I don't get it. They get tornadoes and these terrible storms. Yeah, except the chances of that tornado hitting that house, it may go through somewhere and wipe out 10 homes, but a wildfire is wiping out 1,000 homes. It's wiping out a lot more. So they're able to price that risk and go, yeah, we can give you a reasonable policy and we'll absorb that risk. Because believe it or not, the insurance industry has an unbelievable amount of data nowadays. They are monitoring wind direction, pattern, terrain, fuels, all of that. When they're looking at a house to insure, they know what's going to happen to that house. Statistically,
Right.
they know.
What
Right.
other directions do you see the insurance industry going? You already mentioned a few that rates are going to continue to increase and then probably not decrease, and splitting out of different sections, like for example, wildfire from the common insurance premium.
Right.
What other things, what other directions do you see influencing the industry right now?
Well, I think right now the insurance industry looks at a risk area, and I'm going to simplify it. They look at a zip code and say, you know what, that's a risky zip code. They have whatever happens in that zip code, and they're pricing or making a decision to play in that market or not offer policies in that market. The data, the evolution that's happening, they now by rooftop know very granularly what's happening. So historically, they used to say, we're not insuring that area.
Mm-hmm.
I can see them getting to a point where they say, well, we know that this house, where it's situated, it's up against wildland area. It's not on the green in the golf course, and it has a better chance of having something hit it. Or it's on the downside of a slope and has a better chance of a mudslide. We're going to insure that one higher, or not insure that one, but the one down the street is safer, and we'll insure that one.
So they're going granular to sides of the street and ends of the street,
Yes,
etc.
yeah. And I've experienced it myself. A few years ago, they would blanket. Most carriers would say, up here in Reno, there's a zip code 89511.
Mm-hmm.
It stretches from the wetlands and down in the flats in Reno all the way up into the trees up towards Lake Tahoe.
Mm-hmm.
They looked up and said, trees, wildfire, that's a high risk. We don't want to insure that zip code. Today, they're now looking up and saying, we can kind of go in, and Arrow Creek has got a lot of risk, but you know what? That house is situated somewhere that's pretty good, and we feel better about it. We can see there's 2 points of access. That's a safer risk for us than, property B. That's something that we're now starting to see.
Okay.
It's slow to be adopted. It's not something that's widespread, but um, again, I mentioned the Palisades fire changed everything.
Yeah.
There's some companies that track data. They looked up and they had aerials and they did predictive things. Said, we think that this house is susceptible to burning and this one isn't. Well, they had that data. And then the Palisades and Eaton fire happened and they went, holy smokes, why don't we take that same aerial after the fire and just see how accurate we were?
How'd they turn out?
Some of those companies discovered that they were better than 90% accurate.
Really?
So they looked up and went, you know what? I think the way we're analyzing the data, we're
Hmm.
looking at fuels, winds, and everything else and saying this one has a better chance of burning than this one. We think we're pretty good at it now. That's something that nobody really looked at. When that happened, the insurance industry, a lot of the companies that compile this data started getting the attention of the carriers that said, maybe we ought to subscribe and do a little deeper dive because that's good data. It helps us refine our calculation.
Right.
So
Cool.
that's another evolution that's happening. I think that now go up to 10,000 feet. I think that it's now getting the attention of the federal government. It's getting the attention of US senators, no longer county commissions that are saying, hey, we got an insurance problem here. Now everybody's looking at it. So who knows who will take it on, but it's a big problem. It's one of those things that's, two elephants. It's not one elephant that they got to eat a bite at a time.
Yeah.
And I think somebody that's brave and wants to challenge and kind of go in is going to have to do things like hit up the legal lobby and start putting parameters and walls and fences around the claims and the tort rewards, and doing things like saying it's not reasonable to require this. There's one big one that happened last week. Fannie Mae and Freddie Mac, they decided to make a change to the roof requirement for insurance, so that it qualifies for a loan.
Okay. Explain that. What do you
Yeah,
mean? Do you mean
that's
like
an
the
important.
physical roof of a building, or do you mean?
Yes.
Okay.
So what they made the decision on, it affects HOAs, condos, it affects single family homes, multi-unit structures. Historically, go back 2 weeks ago,
Right. Right.
every mortgage required full replacement cost on all components of that home to qualify for coverage for that loan. So if you go get a loan, you need to go get insurance. That insurance has to provide you replacement cost on if the building gets knocked down, replacement cost if there's a storm and the roof blows off.
Right.
Most roofs in the country are old. The reality is that people can't afford, nor do they replace their roofs every few years, and they're not all new. The change that happened was that they decided to say, we no longer require replacement cost on the roof. We'll accept what's called ACV, actual cash value, or a depreciated value. So a 18-year-old roof historically was insured. If the insurance company covered it, they gave you a brand new roof, whatever it cost. $20,000, here's the check.
You mean if it's
Today,
18 years or more?
let's
Or
say you've got an 18-year-old roof today,
yeah. Yeah.
and you have a storm and something happens to your roof.
Right.
Old rule was if you have a policy that had replacement cost,
Hmm.
they would come in, you'd file a claim, they'd rip off, put on a new roof for 20 grand, and the insurance company would pay the 20 grand to have the roof replaced.
Right.
You're paying for that in your premium because you
Right.
have, no matter how old it is or whatever it is, we got to replace it.
Right.
The new rule says, well, the mortgage company will accept that insurance policy isn't paying the full bill. They're only going to pay a depreciated portion of that bill.
Mm.
So we're not going to disqualify that policy and penalize you as the mortgagee. So what it's going to do is it's going to allow more opportunity on the mortgage side for consumers, because now they're not constrained in the choices. Not all insurance companies will insure a home with an older roof. Now that's no longer an issue for them. So that takes that whole issue off the table. And now that policy that's being written, in theory, that was $2,000 because it had full replacement cost, might be $1,900 today because they can insure that roof at ACV and they don't have to price
Right.
a full replacement.
Yeah, so if I'm understanding you correctly, basically they moved from 2000 annually to 1900, and the reason is if we'll talk about hail damage. If the hail damage happens when it's 5 years old, like here in California, at least here in Sacramento, where I grew up and have operated for the last couple of decades as an agent, it was usually 25 to 30 years. It'd be about the life of a roof.
Yep.
So if you figure a roof well maintained and lasts 30 years, then what you're saying is that if hail damage happens at 5 years, you're going to have a proration where that $20,000 roof, the owner might pay $2,000 of it. And at 10 years, the owner might pay $5,000 of it.
Correct.
At 20 years, the hail damage happens. They say you need a new roof.
They may pay 12,000 of that 20,000.
Right.
Yeah.
And
And that's a significant shift. Literally happened last Wednesday. I don't think
okay.
even the mortgage industry caught wind of it yet. It hasn't hit the journals yet.
No, the mortgage, Fannie Mae and Freddie Mac, I'm understanding, and I might be slightly off here. If you're getting a mortgage and that roof is 15 years old or 18 years old, they're now requiring a new roof to be installed. In other words, to fund that
Correct.
loan.
Yes. So
So
the
that's in
magic
play
number.
now.
Well, the magic number in insurance is they don't care if you have a 40-year roof. At 20 years, statistically, they know that that roof has a 75 to 80% chance of failure once it hits 18 to 20 years. So they just picked a demarcation of 20 years. If that roof is that old, we know it's a high risk and it's going to need to be replaced. So we're not going to cover you. That's
wait,
something that could change.
yeah, let me back up on that because I want to talk about that briefly. This where I heard about it was in Florida, where they were inquiring these if it was to purchase a property, if the roof was X number of years old, then to get insurance on the property, you would have to buy a new roof.
Yep.
Put on a new roof. And so, are you saying? It sounds like you're saying that's likely going to filter through the rest of the nation.
Yes. So
Well,
what
that
I
already filtered into Fannie and Freddie. If you
yeah.
can't get a loan, they won't do the loan unless you replace the roof. So it's outside of the insurance.
Yeah,
Has nothing
that's
to do
what's
with insurance.
changing though. That's what's
Yeah.
changing.
So
So
that's
on
a
the
help.
mortgage side, they've acknowledged it. The insurance side has to catch up. So the carrier now looks up at a roof and says, I just don't want to. The roof is 21 years old. I'm not insuring you.
Right.
They'll eventually get to a point. This is one of those evolutions in the industry that may happen.
Yeah.
I can see them looking up and saying, you know what? If the mortgage is going to accept that, and we can not have to write such a big check, we will be willing to insure at ACV, not replacement cost, and we'll give you a policy. The big
Okay, so you think that's going to shift then in Florida, where they will give a policy on older roofs, but it's incumbent on the owner to be more responsible for it.
It would be a proration.
Yeah,
the proration comes into the policy.
The insurance company's abdicating some of that responsibility for
yes,
replacement.
that's what I see is going to be a big conversation and potentially shift. Now, here's the big aha for all of your viewers and your clients.
Yeah.
That's great. Oh, wow. Look at that. I'm saving on my insurance policy. And guess what? When that 18-year-old roof has hail damage and it's got to be replaced, instead of writing your $1,000 or $2,500 deductible, you're writing a $2,500 deductible check and you're writing another $8,000 to make up the difference for that depreciation on that new roof. So
Right.
exciting that you can get insurance, exciting that the monthly is a little less,
Mm-hmm.
but at the end of the day, the insurance industry is pushing more responsibility to the consumer, and that is where I see the industry as a whole moving. They have always been doing it, but now they're really starting to say, we can cover things, but we need you to put a little bit more skin in the game. Started with higher premiums, started with bigger deductibles. Now it's going to be things like, we believe that you need to put some skin into replacing that roof because it's old. You go have an old car, you get
Mm-hmm.
in an accident and it's 20 years old, they don't give you $80,000 for a new car because I want replacement cost. A new car is 80
Right.
grand. No, you're getting $8,000 because that's all it's worth today. That is accepted in the auto world. That's starting to move to components of a house. And that's kind of the theory behind the roof. It's
Mm-hmm.
something that you should maintain. Yeah, one of our staffers here, she gave a great analogy. She came from the fire restoration world. And she said, I love it. I go in somewhere and somebody complains about whatever it is that they got to pay for. Hey, you pay for new carpet, it lasts. You can't have a carpet that's 23 years old. It looks 23 years old. You get new carpet. It's just something you plan on doing. It's a big ticket and you do. People don't think of their roofs that way. They don't think of their bigger ticket items to maintain them the same way, but they have to. And that's the industry, insurance industry, is pushing consumers to start thinking like that.
Right. That makes sense. What are some of the biggest changes do you think that are coming up or have happened recently that affect investors in insurance, residential investors?
I think I think that the biggest shift for investors, and I see this often with a lot of fix and flippers and people that are fixing and become a landlord.
Mm-hmm.
Um, most what I've seen, a lot of investors are going out there and they are doing the cosmetic fixes. They take an old rundown place, they strip out the old carpet, they put up nice crown molding, they paint, they do some new countertops. The place looks immaculate, beautiful home. And they go,
Mm-hmm.
great, we want to go, we're going to go get insurance because we want to start renting it out. What they're missing is they're not looking at the underlying systems. And that's what the insurance companies care about. They don't care that the paint looks good and that it's got new carpet. What they care about is, well, did you upgrade the plumbing? Did you upgrade the electric panel outside? Hey, it's an older place. It's got a 100 amp service. Did you upgrade it to 200 amp?
Mm-hmm.
What did you do related to the systems? What did you do to the roof? Those are things that historically carriers were a lot looser about. So
Mm-hmm.
as an investor, you could go buy a place, get insurance. You didn't really think about it, and you didn't have to invest as much money to make it qualified. Today, they're starting to look at those things and putting their foot down. You gave an example like, hey, if you got an old roof, you have to replace it. Historically, insurance companies didn't operate like that. They were okay with it. 30-year roof, it looks in good shape. We're okay.
Right.
Today, we need you to take responsibility and fix that so that it starts off in a good point. So they're looking at roofs, plumbing, electric, HVAC. Those kind of four systems they view as a system, not a product. Roof
Mm,
is a
okay.
system. Great,
Mm-hmm.
you put new shingles on, but did you actually pull it off and change out the felt paper underneath and reseal and tape it off? Because that's where the failure point is. For your
Yeah.
plumbing, hey, you got a 1970s place. Did you check to see if it has galvanized pipes? Because you might need to redo that piping, or you've got a pre 2010 PEX that's no longer acceptable for insurance companies. Did you get a plumber to go make that change in that older place so that you don't have a leak?
So question on the PECs really quick.
Mhm.
After 2010, it's held up. Because I know that
So what they just
previously.
pre 2010,
Uh-huh.
they discovered that that material, that manufactured product,
Yeah.
had a high incidence of failure. It was
Okay.
failing at joints, and it was failing quite a bit. So they look up, and if they see a home that's older, they're going to ask the question. In the pre-underwriting that we do, it's a question we get asked. We know that we have to ask, when was the last update? When was the last what year was it built? Oh, does it have PEX? What kinds
Right.
of piping? Um,
But
most
the stuff after 2010 hasn't had any problems.
no, that's that 2010 is what they're asking. Is
Okay.
it pre 2010? Um, you know, here's the reality. This covers almost everything for your investors. If they update kitchens and bathrooms
Yeah.
almost all the time, as long as they're using kind of a licensed, reputable plumber, they're going to look at that stuff. They know that certain kinds of pipe are outside of code. Old
Mhm.
buildings that have lead pipes. Hey, this is a health hazard. It's no longer allowed. We have to change it. So
Right.
that's why the insurance companies ask, did you do an
Now,
update?
now, are they requiring it, or are they simply saying we won't do it? This other company will. They're going to cost you more.
Um, so where it comes up, some of them are going to get really Gestapo about it and say, we're not going to insure you unless.
Right.
But the reality is, you can roll the dice. If you have a claim
Hmm.
and it's a water claim, and they go in and it's a 1990 house, and whoops, they discover that there's pre 2010 PEX,
Right.
and the PEX wore out. That could be a ineligible item, and when you file the claim, they can say, you know
Mhm.
what, you had something that wasn't eligible, you had something that was proven to be a failed product, we're not
Right.
covering that claim.
Right. Now, two questions on this. One, second one's regarding inspections, but the first one is, are all of these mentioned in the policy itself? That is, if you read through the policy, the 8-point print, or that
4 point.
will the previous to 2010 PECs be listed as a line item in there, or are the insurance companies just going, well, we have our list. If you happen to have looked at our website covering all the things that we don't cover, then maybe you would know this, but here's our list. And, so is this something that's very much in front of the consumer? Because I know when I do insurance, I don't want to spend 2 hours reading through all the things that they don't cover. I just assume that
Right.
they're covering everything, or
Right.
pretty much
Which is
everything.
right, because that's how insurance is written nowadays. It's,
Yeah.
we don't cover, you know, we cover wind, hail, water. That's
R-
kind of it. Okay, well, I'm covered if anything happens.
Right.
Wind, hail, fire. Um,
So where are those exceptions found for a consumer who
so
wants to know what's going to be his
very
property is going to be
savvy
exempt from?
attorneys write up these agreements that do things like must be built to current building code. They know that we've discovered over time that lead pipes are a widespread health hazard for lead leaching.
Sure.
Therefore, they are no longer allowed. You must bring it to code. So they don't have to go in and say, these are the every specific item we can come across. Um, they tell, in general, they tell us, like when we go do our pre underwriting, we've got these cheat sheets that we know that these carriers say Zinsco breakers are, they've been proven to fail. We don't accept those.
Hmm.
Is it spelled out in their policy form that they have that specific brand? Probably not, but they know that that brand is an excluded item from building code because it's been proven to be an unsafe product for the public.
Right.
So they tend to cover things more of a broad brush than saying, here's the list of 50,000 things that we don't accept. They say, this is what we do accept. Everything else we're going to evaluate.
Okay, so speaking about Zinsco, how is the insurance company going to handle a fire that happens from a Zinsco breaker on a property that's built in 1956 here in Sacramento? We literally have
Yep.
tens of
Yep. They're
thousands of
all over the
Zinsco
place.
breakers.
Yeah.
So are they just going to say, yeah, we've been insuring this property for 30 years. We're gonna take the hit, or are they going to say, sorry, you have a Zinsco breaker. We didn't let you know, but we're not going to cover it.
So it all goes through the claims process, which
Hmm.
what's going to happen. Let's say that scenario happens. Claims adjuster comes out to the property. They go out there to determine what was the loss and what was the cause of the loss.
Right. Yeah.
Once they determine that, you know, I don't know. That's something that it's almost like you want to ask a real estate lawyer to look up at case law and go, how was that defended? Like, were they really covering it, or because it was that product that, they never did anything to home to have an electrician say, oh, that needs to be changed, and now we're not covering it. They're going to think this is where the common sense comes in. You're an attorney, you look up and somebody went and did 3 updates to their house and they had
Mhm.
electricians looking and they failed to fix something that's a known problem.
Right.
Chances are they're going to, in their claims review process, they're going to look up and say, oh, we know what it was. Hey, guess what? 3 separate incidents, this came up and nobody addressed it. That's a problem. We're not going to cover it. But if you never did anything and it's an elderly couple finally sells their place or it burns down and they discover, well, there was never any reason to go check and make that change, we're going to cover it. It
Right.
really just goes back to common sense and how they're going to review it. If somebody's gaming it,
And whether they feel like they're going to get sued or not.
right. Yeah.
Now, here's a question. Is insurance companies, at the time you get the policy, I'm understanding that they're sending inspectors out directly
Yes,
related to the insurance company. So they're going out, double checking the plumbing, they're checking the electrical box, they're looking at roofs, a lot of very specific things.
yep,
And so you'll be insured, but within 3 months or so, an actual inspector from the insurance company is physically seeing the house.
correct.
And that's what's happening, right?
Yeah.
So yeah,
Is that happening everywhere? That was my second question because I've
yeah.
had properties that,
Are the insurance companies asking for home inspection reports? Because we all tend to do that when you're buying a house. You have a home inspection. So are insurance companies requesting before close of escrow any reports that are done on the property?
No, so this is how it works. When you go get a new policy, historically, it was the exception that they sent down somebody to go inspect. Today, it's the rule.
Right.
Pretty much assume every time you get a policy, someone is going to look. And that look is going to be anywhere from what they call a drive-by. Somebody will drive up to the property. They will go take pictures. They will look at the roof. They're looking to see that when you wrote this policy, you said that the roof was in good condition, was approximately 5 years old. You said that there weren't trees overhanging the roof and it was well kept property and that there were no holes in the side of the building. That's kind of the lowest level that they look at. The reality is that they're probably coming and doing a walk around where they'll go look and they may go take a picture of the electric box and see what kinds of breakers are in there. They're relying on their inspection to do the 10,000 foot. This is what they said I'm insuring, and this is what we're insuring. They do not ask for that home inspection, but they may ask for specifics. I had a new roof put in 8 years ago. It's in condition. They look at a satellite picture and say, can you show proof that you had that work done and that in fact is only an 8-year-old roof? That they will ask for. But they typically won't ask for a third party whole house inspection and they won't rely on that because that it's sometimes they're looking at different things. I mean, to nowadays, those reports are very comprehensive. They're using software to ask all the questions. They got a lot of tie-ins to go, is it a Zinsco breaker or not? But they're on asking because, it's one of those things. If I don't see it, then I can claim I didn't know. They aren't looking for more information, or looking for what we as a agent are pre-underwriting and telling them, what the consumer is telling us, and then they kind of do a visual validation. Now,
So
along,
if they're asking for proof, is it possible that you could hire a professional to come out and actually do a report? Because sometimes if you buy a house, there's no way you have receipts or anything to verify that the roof was 8 years old or
yeah,
even 10. So you could have a roofer come out and do a cert,
yes,
like a roof cert or an inspection of the life of that roof into
yes,
the future.
yeah,
An
and they'll
insurance
do it.
company will
And
accept that.
most times, what they're looking for is the underwriter is just looking for something to demonstrate that I saw something that looked like it is way old. You're telling me it's newer. If a roof inspector comes, he knows what he's doing. He's going to take pictures of that surface. He's going to take pictures of, the edge to see the underlayment. He's going to give his professional opinion and give a report and say, my opinion is this roof is 8 to 10 years old. And they're going to look up and say, a reputable professional looked, they confirmed it. I've seen the pictures. Check the box. I'm okay. Um, Here's something else that's happening on the inspection side that, it's good for everybody to know. Um, they do send people to physically go look. It's usually a third party that comes out. They do
Mhm.
the walk by and the pictures. They're now using technology, and they're using low orbit, high resolution satellite imagery. They're using drones. They're using a lot of the things that you and I can go do today. Thank goodness for Google Maps. I can go in and look at a property halfway around the world, and I can see what's going on. They're using this data to go validate and to go confirm. You tell me, hey, it's a 10-year-old roof. Well, they're going in and having data and having satellite imagery and saying, you know what? In a photograph, I can see that that roof is deteriorated. I can see that two tiles are missing. That's a problem. Historically, they never did that. So you said it
Mhm.
was 10 years old. They took your word for it. And then 15 years later, you file a claim and they pay it and they go, well, we didn't know the difference. Today, technology gives them the ability to check a whole lot.
Right. Now, it seems like they're doing that because they're trying to minimize the amount of claims that they have. And it seems like they're doing that because they're receiving so many lawsuits and
Mhm.
large claims in other areas. You said 20 to 26 each
Yep.
year for the last 7 years.
Yep.
Well, the way I look
Yeah,
at it is not only they're trying to limit their claims, they're trying to justify the increase in their policy coverage, their policy premiums.
Yeah.
So they're trying to get it on both sides.
Yes. That's a very, very good
Yeah.
point. They come in to say, hey, guess what? That house we're insuring at 300,000 replacement in today's market, that's actually 475. They get more premium. So they're making
right.
those adjustments on both sides.
And then they amortize or depreciate the individual items. So the depreciation part is starting to come into the industry, roofs, decks, whatever. Um, okay, so that makes sense. So they're trying to lower their outgoing costs by dealing with depreciation.
Right, right. Well, let me throw this number out, and this will probably get everybody's attention. In a typical year, the insurance industry absorbs $308 billion of fraudulent claims.
Mm.
Just
Fraudulent
bogus,
claims.
fraudulent, not a real claim. They absorb that every year. That works out to anywhere between $700 and $1,000 per insured in the United States.
Are they attacking that in such a way that they can eliminate those claims? And
Yes. that's, going back
Have a
to,
task
well,
force or something.
why are they doing the inspections? Because they're going back. Somebody says, got a 3-year-old roof. I'm insuring my home value's this. Something happens, a fire happens on the house, and all of a sudden they're having to write a $450,000 check to rebuild that house. Well, guess what? It was a 38-year-old roof. The house was in poor condition and they never checked. Now they're checking. Now they're doing it to help curb false information, misinformation, or flat out fraud.
Wow.
Yeah,
That's
it's
a
a
big
big
number.
number when you distill it down and go, I am paying, I'm absorbing $1,000 per me. They have to pay for because other people are gaming the system. Gee, that's
Hmm.
not good. I hope you guys are doing something about it. They are. They're
What are
using
the most common
technology.
ways that people game the system? This is not intended to be a how-to manual, but
Yeah, yeah. Well, I
like
mean, okay. So
like
here's ones that we can all see and visualize. This is part of the problem in Las Vegas.
okay.
Um, Nevada in general is among the highest auto premiums in the country
Hmm.
because we have a lot of claims and a lot of poor driving and fraud. Somebody's driving, hits the brakes, you rear end them because they hit the brakes for no reason, and they get out of the call, grab their neck, and go, "Oh my God, I'm dying here. I can't work for the rest of my life." They sue. That technically is a fraud claim unless you have a dash cam and can prove they caused that themselves. There was not any reasonable reason they stopped or I wasn't paying attention. So an insurance company ends up paying out. They pay for all of the medical and they pay for all the pain and suffering.
Yeah.
That's kind of one that we can all see. Here's the other side that's more common and people don't think they're doing anything wrong, but they are. Um, I got a leak in my kitchen sink, didn't catch, water hit underneath the sink, kind of flooded. I noticed I walked into a puddle around my refrigerator. Oh my gosh, I've got to get my flooring redone. Um, could be a few $1,000 claim, but somebody goes and claims, my God, my cabinets are ruined. Everything's ruined. I need a new kitchen. Contractors, everybody's complicit in this. They're not blatantly doing something. Yeah, there was damage, but they game the system to go, I took an $8,000 fix and turned it into a $38,000 new kitchen.
Right.
Uh, we see it happen quite frequently where somebody says, "Oh, yeah, I got a new kitchen." Really? Why? Well, my dishwasher hose came loose and there was water. And so you got new cabinets up above, you got everything. Well, it all had to match. So I had to get it all done. And well, because the floor actually ran into the other part of the living area, I got all new flooring. Those are things that we think are like, well, it's not a big deal, right? I mean, I did have water damage, but I kind of exaggerated a little to get more. Well,
Yeah.
technically, that's fraud. Technically, you're costing everybody more because now the insurance company's paying out more than they should have.
Right. Cool. How would you end us today? Like, what are your final thoughts on insurance that investors
Yep.
and consumers should know?
Well, a couple things. One, stick in the back of your mind that the industry is moving to more personal responsibility.
Okay.
You can't view insurance as it's somebody else's problem. Start looking at it as, I think if I maintain my stuff, I won't have a problem. So
Hmm.
that's one. And, two, it sounds self-serving, but even if you don't come to our brokerage, go to an insurance broker. A broker has more options and can give you a much better option value and pricing than you can with a captive. I can say that with confidence. I know the last two Nevada insurance commissioners I know personally. Both of them have openly in the public said, when you go for insurance, go talk to a broker.
Hmm.
Don't talk to a captive, talk to a broker. They have more options and can take care of your needs. So view insurance as kind of that catch-all. Go talk to somebody that's well informed and knowledgeable. Not all insurance agents and agencies are equal. So recognize that and shop it around. You know, using your friend because you always have might not be in your best interest.
Kevin, thank you so much for your time today. We really appreciate it.
Yeah, thank
Yeah,
you. I
very
appreciate it.
insightful.